Hello, everyone. My name is Sean, and today I'll be going over session six, the valuation slides for the Smith Fund. And I hope you guys enjoy. I'm going to try to make it as fun, easy, and simple to understand. So let's get right into it. So for the learning objectives today, the students are going to learn to analyze a public company and basically understand how the company's worth, how to understand the valuation metrics, and ultimately make investment recommendations as to if they should purchase the stock or buy into the company based upon the valuation metrics that we're going to learn today. Also, understanding balance sheets, income statements, and whether it's really worth to buy or sell or even hold a stock in the future based upon what type of stock it is. So let's get right into the key terms. So the key terms are very important to understand. So let's get started with the first one. So the first one is comparable analysis. A comparable analysis is very simple. What you're doing is that you're taking two companies and you're looking at them side by side and seeing how they compare within their market, their overall industry, how profitable, their income, and just basically cross-referencing to see how they compare to one another and how they compare to the overall market. A really good example would be like comparing Tesla to a Ford, right? Both car companies, but two vastly different type of companies. Tesla, a growth stock, very modern, more techy, very into the whole software AI side. Ford, a more traditional car company, also now going towards more tech oriented. But you can see how these two are different companies, even though they're in the same industry, they're vastly different from one another. So it's very important to do these type of cross-reference analysis to see how they compare to one another in their market. The second is a growth stock. So growth stock, like I said earlier, like Tesla or Nvidia, is a stock that is going to be not paying dividends, but is going to be a very high value stock. And a stock that's going to grow well, it's not going to be a value stock, but it's going to be a stock that tends to increase its capital value rather than yield a high income. So a stock that has a very high demand and very high interest within the investor community because of its potential earnings, because of its market, what it's doing. Like, for example, Nvidia. Nvidia has a very, very, very high profit margin, and they are growing very fast. So Nvidia is a perfect example of a growth stock. Valuation. Valuation is essentially the analytical process of determining the current value or the worth of a company based upon its assets. So you're going to add up its assets and you're going to figure out, based upon what assets it holds, what the overall valuation of a company is going to be. The fourth is value drivers. Now, in my opinion, value drivers are very important because value drivers really tell you or kind of, indicate how a company or business is going to do in its overall industry. And the key value drivers are its product, its service, the assets it has, and its overall business. So, for example, if you're comparing a company that, let's say, doesn't really have a very strong demand for its products or its services, that is going to be a very, very important metric that you're going to have to understand because if its product or service doesn't really have high value or demand, that's going to have a very big impact on its overall industry or its overall company. So that's something that you have to really understand and kind of analyze so that when you compare it to, let's say, another type of product or industry, you can say, maybe I shouldn't buy this stock in this industry because this industry is really not that high in demand. The last one is value stock. Now, value stock is a stock that has very strong fundamentals, more of an older company, very solid company that's been around for a while, very consistent, but is priced below the overall average based upon PE ratios or its overall, yield aspects to other companies in the market. A perfect example is like a company like a Ford. Ford in the car industry has a lower than average priced is priced lower than average, but its earnings are incredible. It's very stable and very reliable. So just because a company is priced below the average, it doesn't mean it's a bad company. It just means that it's a different aspect compared to a growth stock that's above the average in terms of PE ratios because investors are basically hoping in the future it's going to make so much money that the high valuation is worth it currently. So, just to go into more detail, evaluation analysis is the analytical process of determining the current worth of an asset or a company. So, it's very important to understand the assets of these companies because if the assets really aren't worth anything, then its whole valuation is basically gone. And you can use this analysis to understand its fair value based upon the overall industry it's in. And a company can be valued on its own on an absolute basis or else on a relative basis compared to other similar companies or assets. So that's also another metric that you can use. You can cross-reference with other companies and based upon their assets they have and see how it compares to your assets. So think of it like this. You're trying to buy a house or a piece of art, a phone or company, and you want to pay the fair market price. So how are you going to do it, right? How I would do it is very simple. You look to see what other products in the market are asking, right? I'll give you an example. Let's say you want to buy a house, and the house that you want to buy is currently asking $500,000. However, there are markets in the area, very similar build, very similar layout, similar lot size, basically very similar to the house you want to buy, but those homes are asking 300, 350, 375. You're going to tell yourself, why am I going to pay 500,000 if the other market comparables in the area are $100,000 or more less, right? So you're going to use comparable analysis within the overall market and see if that house you want to buy is really worth 500,000. Same thing for a piece of art or a company you want to buy. You always want to pay the fair market price. And that basically means cross-referencing with what other people are asking. So, for valuation analysis, so there are many different valuation analysis that can be brought to bear for valuing companies. So, whenever we are completing evaluation, you have to understand how the actual business runs or what type of business it is. So, for example, as I said earlier, there's different types of companies. There's growth companies, like a Tesla in its example, or more of a value stock like or a more traditional, fundamental, stable, mature business, a business that's been around for a very long time, provides dividends like Coca-Cola. And you can use these two companies and compare and contrast to see how they differ within your overall valuation analysis. So Tesla is going to have a higher valuation, right? Because it's seen as a growth stock and it's seen as a company that's going to make so much money in the future that I'm willing to pay more for it currently based upon a company like Coca-Cola that's more stable. You think in the future it's going to keep its same stable fundamental growth, but it's not going to do anything crazy like Tesla, where you think it's going to have a 100x return. It's going to be so much more profitable in the future, which is why investors are willing to pay more for like a company like Tesla. And Coca-Cola is more priced within the average of its market. So if you're valuing you, right? If you were to give a value, yourself a value, which characteristics would you be sure to highlight? So that's very important in my opinion. So if you had to think about something, what would you use? Now, let's say if you're comparing you to someone else, you're going to compare maybe you have more educational value, maybe you have more understanding within a business that you're trying to get into. That's going to make yourself more valuable in the overall market. And basically, whenever we're talking about people, the market is just other people, right? Because whenever you think about it, if you're in a market and you're one person and there's a billion other people in the market, you're just comparing yourself to everyone else. So how you'd compare yourself and give yourself value is what you have that other people don't. So that's kind of like a way that you can kind of see how your value is comparable to others in the market. So, how would you value a home? So, to value a home, in my opinion, you would compare it to what other homes or what other aspect homes have in the area. So, how would you compare it? You would compare it based upon what year the home is, what its lot size, how big its overall land is, that's what lot size means, What type of build is it? Is it a modern home? Is it a more Mediterranean type home? Would you consider where it's located? Is it located very far out west, where, let's say, that's not more of a desirable area for people that want to live out there? Or is it worth, let's say, located more east to like where Miami Beach is, which has a very high value, which means the price will rise? So these are things that you can kind of compare and contrast and see what type of value a home really has. So, how would you value a company? The same thing, right? You would look at its fundamentals, how much money it's making, where its industry is located, what its overall profitability and margins are. So, these are very important metrics that you would use to value a company. So, value drivers. So, in order to determine the right valuation method, it's important to think about the key value drivers for the company. And that's what kind of we talked about earlier, which value drivers are very important. So, in other words, what will be the elements of the company that will lead to long-term cash flow. So if you're thinking like Tesla, right? I'm just going to keep that example going. A Tesla, what's going to be something that's going to basically provide its long-term cash flow? It's self-driving capabilities. That's going to keep people coming in because let's say people don't want to drive, they can just turn on a button and the car goes. So that would be a very key element of a company. Maybe the Optimus robot that Tesla's trying to do, that will be part of Tesla, which is going to be part of its overall cash flow and how much money it makes. Maybe the robo bus that Tesla wants to do in a couple of years from now. So you have to think about what is the company doing to keep the cash flow machine going. And that's very important to understand if the company is to keep its profits going in the future. Now, it's also important to remember the three P's: people, product, and process. So it's very important to understand these three P's because they can be key value drivers within the company. And in my opinion, the product and the process are very important. People is also important, but if you have a very stellar product and your process is efficient, it's easy, it's simplistic to understand, and it's mainstream, your value is going to be a lot higher than a company that's very difficult to start or a process that's very non-intuitive and it's very difficult to go in a very efficient mainstream manner. So that's also something that you can understand. Same thing for product, right? If a product is not really desirable and it's not really in high demand, that will be something you have to kind of understand to see if this company is really going to keep its cash flow going in the future. So for valuation methods, we're going to look into Harvard Business because they have six methods of valuing a company. And I learned all this in college. So as a high school students, we're going to try to keep this in a very simplistic manner so that you guys can really understand how these six metrics work. So let's just go into the article and we're going to go step by step, very simple, to try to understand what these six valuation metrics mean. Okay. So the first one, as we saw, was book value. So a book value is most likely the easiest one to understand. What a book value is essentially you're taking the company's assets, basically the assets are non-liable aspect products. So aspects, sorry, assets minus liabilities and you're also excluding any intangible assets, so assets that are not physical. So you're taking assets minus liabilities, which is basically debt, or it could be other aspects, other things as well, but it's mostly debt. And then you're also subtracting any asset that's not tangible, any asset that's not physical. The second one was a DCF. Now, a discounted cash flow, I'm trying to think, let's if we can keep it simple. A discounted cash flow is you're taking the terminal cash flow, which is essentially at the end, you're taking all the cash that a company is willing to generate after subtracting any type of debt or liabilities. And you're dividing that, you're taking one plus the cost of capital, which is the discount rate, but that is that is basically the interest rate that a company wants to hypothetically make in the future. because obviously all companies want to make money, right? They want to keep the cash flow growing. So cost of capital is essentially the discount rate. And discount rate is what you want to what the interest rate you want in the future to be based upon today, right? And you're taking the number of years in the future because remember, time is a very important aspect in business. And in my opinion, time is the most important because time is what keeps everything going and what keeps you to basically calculate these calculations. So the third is market capitalization. Market capitalization, in my opinion, is the second easiest. So market cap is you're taking the share price. So let's say the share price is $10 and you're timesing that by the total number of shares. Let's say there's 100 shares. So 10 times 100, boom, we got $1,000 of market cap, right? So now we can take that same aspect to Tesla or AMD or Nvidia or any type of company, and you can calculate what the market cap is for that company. So currently, right now, Microsoft, Apple, these are trillion-dollar market cap companies. So if you take Apple's stock price and you times the number of shares it has, that gets you the market cap. The fourth, enterprise value. So enterprise value is you're taking the debt, you're adding any equity that is provided in the business, and you're subtracting its overall cash value. So essentially, how we like to do this is that, for an example, debt is we're gonna go a debt is a liability. So what you're gonna do, for example, if you want to calculate the enterprise value of Tesla, right? Well, this is very old, but Tesla's market cap is probably around $1 trillion today. So to find the enterprise value, you're gonna take 1 trillion, you're gonna add its liabilities, so it's debt. So let's say its debt is 50 billion. So that's gonna be 1.05, right? And then you're going to subtract it by the amount of cash it has. So let's say Tesla has 10 billion or 10 billion in cash. You're going to subtract that by its overall debt, and that gets you its enterprise value. So that's another metric to calculate its overall value of a company. The fifth one, so make sure, yeah, fourth, fifth. The fifth one is EB, EBITDA. Sorry, I had a little cough there. EBITDA. So EBITDA is you're trying to figure out what the company is basically getting in cash flow while you are subtracting interest, taxes, depreciation, and more, right? So if you wanted to find the EBITDA of a company, what you would do is that you would get its net income, and then you would add its interest, its tax, its depreciation, and its overall amort value, and that gets you its EBITDA. So EBITDA is very important to understand the raw value or what the company's actually making because you don't want to include all of these other metrics. So that's kind of why we use EBITDA. And the sixth one is present value of a growing perpetuity formula. And this is a little bit more on the complicated side. But if I had to simplify it, if we ever watch Shark Tank, right? And Mr. Wonderful says, I want it in perpetuity. Perpetuity basically means forever. So whenever you want to find the present value of a growing perpetuity, think about it like this. Money grows or gets more expensive every year, aka inflation, right? So to find the present value of a growing perpetuity, what you're going to do is that you're going to use this formula and basically calculate what the current value of the current value is based upon your interest rate, the inflation rate of the future. And I know that sounds a little complicated, but if we want to kind of simplify it, you're going to take its cash flow, so the current cash flow, divide by the cost of capital, aka the interest rate you want to attain, and you're going to subtract the growth rate, which in this example is basically inflation. So, for example, let's say your cash flow, you have $100 in cash, right? You're gonna take 100, you're gonna divide you're going to take, let's say you want to make 10%, 10% is your discount rate. So what that means is that you want to make a 10% return on your money. What you're going to take the 10%, the discount rate, you're going to minus the inflation, right? Because money gets more expensive every year. So you'll take 10, let's say the growth rate is 3, so inflation is 3%, which means every year money gets more expensive at 3%. So the real net value is what? It's 7%. So you're going to take 100 divided by 7%, and that will get you the value of the growing perpetuity for whatever you're trying to calculate. So going back to our slides. So let's do a brain break. Fun fact, did you know that Burke's stock is $170,000? And this is very old. Right now, Burke is probably close to $1 million, which means Buffett doesn't split the shares. He just keeps the stock price growing and growing and growing, right? Because if you wanted to split the shares, that would make the stock price cheaper, which means more people would come in and buy the stock because you have more access to capital. If you only have $1,000 in your portfolio, you can't buy a $700,000 stock. But let's say that $700,000 has a stock split, and let's say now that $700,000 stock is, let's say, worth 1,000 a share, you can buy one share. Versus if it was $700,000, you would have to buy a certain fraction of a share, and that's kind of, it's a little, fun fact for, how stock splits work, but it's very interesting. Burke A hasn't split its stock for a very long time. So going back to what we did earlier, growth stock and value stock are two different things. So a growth stock is a developing company, a newer company, very quick, very shiny, a lot of potential, a company that's not going to pay dividends because the investors are going to make more money off of the return of the stock, right? If NVIDIA has a 40% annual return, why are they going to issue dividends, right? It doesn't make any sense. So these are companies that you expect very high short-term earnings, very quick potential. No, not quick potential, but you expect that the companies that grow at a very fast rate. Value stocks are different. They're more established. They're older. IPM, Intel, Coca-Cola, Visa, Microsoft. These are companies that are very traditional. They're more fundamental, solid earnings, pay dividends because they are not going to really grow at a very fast interest rate return versus, let's say, a growth stock. To give you an example, Coca-Cola stock, let's say, has a 8% return every year. However, it also gives, let's say, a 4 or 3% dividend. So you get the 8% off of the stock appreciation every year. And on top of that, you get the dividends. So that's kind of how it's a little bit different. Depends upon what you want to invest. If you want to do more growth or value, it's up to you. So the students could watch this video. This is basically going to teach you about company valuations. So we can watch this really quick.
How to value a company, explained in 3 minutes. Let's say you have a lemonade stand. It has a table worth $10, a pitcher worth $5, and drinking glasses worth $5. So a total of $20. If someone offers you $21 to buy your lemonade business, what would you say? Maybe you'll say yes, because its assets are worth only $20. But what if your lemonade business is safely and consistently earning you a net profit or cash flow of $100 a year? Would you still sell it for $21? Of course not. You will get $21, but you will lose $100 every year forever. So, if I want to convince you to give up $100 a year forever, how much would I have to pay you? Simple. I must give you enough money to deposit in the bank so that the bank can give you an interest of $100 a year. That way, you can still earn $100 per year, even if you don't have your lemonade business anymore. How much money do you need to deposit into the bank so that the bank will pay you interest of $100 a year? If bank interest rates are 10%, then you would need to deposit $1,000 to earn $100 a year, because $100 is equal to 10% of $1,000. So now, what is the value of your business or company? Is it $20, which is the value of its assets? Or is it $1,000, which is the value based on yearly earnings? As financial managers, we tend to value a business based on the value of its earnings. So in this case, it would be $1,000 and not $20. Of course, this was just a super simplified story and example to teach the basic concept. Do you also want to learn how to calculate the value of a company or business based on earnings? Watch my free video at mbabullshit.com. See you there.
Okay, so that was a quick little understanding about how to value a company and give you an example that was pretty interesting. Okay, so now let's just compare, right? Coca-Cola versus Pepsi. So Coca-Cola is $59, Pepsi is $169, and its EPSs are different, right? So PE, so that we can kind of understand how what these actual metrics mean. PE basically means price per earnings multiple. So the higher the multiple, the more the stock price is compared to its earnings, right? So, because it's all based upon the numerator and the denominator. So, if a stock has a higher PE multiple, that means it's worth or it's perceived in the market as being a very high, more expensive stock, right? If the PE is lower, that means it's not as perceived as an expensive stock compared to the overall PE average, right? So, let's say, for example, for the beverage industry, the average PE is 20. In this example, both Coca-Cola and Pepsi will be considered above average, which means Coca-Cola is perceived to be a more expensive stock and it's going to be worth more for its shares compared to the overall industry average of 20. So that's really important to understand because PE multiples are how we basically value or base stocks based upon their overall averages. So tech stocks, for example, like Nvidia, has a 60 PE. That means its price is 60 times its earnings, which is very expensive, right? If the average, let's say for a semiconductor company is 30, that means Nvidia is twice the average. So it's very important to understand how these PE ratios can be used to determine the overall market value of those stocks. So, so to research activity, right? So using the information learned, so you're going to research Apple, Samsung, and Microsoft, and you're just going to understand and summarize the companies and provide some hints as to how they might be different from each other and do a comparable analysis. Review its market cap, its share price, its multiples, and actually see if Apple, let's say, is priced higher compared to Samsung or Microsoft based upon its earnings. It'd be very interesting. So, session review. The valuation process assigns a value to a company. Remember, valuation is the most important thing to understand whenever you want to buy a stock or really understand how a company is worth or how much it's really perceived in the overall market. It's also important to consider the characteristics that make a company comparable to properly complete a comparable analysis. So we know we went over multiple type of valuation methods to suit different companies. I think it's very important to use all six or to understand all six, but whenever you're trying to dive in, really understand how a company is perceived and what its overall valuation is based upon its earnings, its profitability, its margins, and how that compares to the overall market. That's very important because you want to compare how a company is to other companies in its industry. And remember, value stocks and growth stocks are very different, and they're perceived as very different in the overall stock market. And you'll see that once you study stock charts, how rigorous and how extreme the growth stock charts are versus a value stock, where a Coca-Cola is like this versus a growth stock like a Nvidia or a Tesla is like riding a roller coaster. So it's very important to understand that they're two very fundamentally different. So if there's any questions in class, please ask with your teachers. And that was it. I really hope you guys enjoyed this session. I try to make it as fun as possible. Hope you guys have a great day. Thank you so much for listening.